You might think the banking collapse we face now started with the Silicon Valley Bank's failure, or maybe with the $5 trillion pandemic stimulus for the US economy. But the truth is that these are consequences of something bigger, something that started over a decade ago. We'll come back to this in a moment. For now, let's see what's currently going on with the banking system. Are we on the edge of a financial crisis? And how did it all start? To understand why SVB failed, we should first talk about how the banking system actually works. Did you know that your bank only holds a portion of your money? The law requires banks to store 10% of their customers' deposit. If you bring $10,000 to the bank, they only have to keep $1,000. This practice is referred to as the fractional reserve banking. So where does all the money go? Well, the banks take the rest of it and start using it to make more money by acquiring assets or lending this money to someone else to earn interest rates. This is exactly why panic is the primary enemy of the economy. When people panic, they tend to take cash from the banks and sell out stocks. As a result, banks struggle and the stock market goes down. That's why, for the banking system to function, citizens should remain calm and believe that their money and investments are safe. And the government's role is to reassure people that the situation is under control.
Americans can have confidence that the banking system is safe.
And the U.S. banking system remains sound.
The fact that banks keep only 10% of the deposited money, it's good for the economy's growth because there is money out there for businesses to borrow and produce added value. At the same time, this can make the banking system fragile in the face of instability. That's precisely what happened to Silicon Valley Bank. Most of its clients were startups, and the tricky thing with startups is that most of them don't earn money, they raise it. However, startups have been struggling to get funding lately. Investors were holding back because of higher interest rates and the uncertain economic situation. So SVB startup's client decided to pull their money from the bank. SVB began to run out of cash, so they needed to sell some assets, which is pretty standard. But there was only one issue though. SVB invested most of its customers' money into bonds, a perfectly safe investment. It gives a relatively small return, but over the years, you still get your money back with some interest. It was fine until the Fed started to raise interest rates. Because SVB bought bonds at low interest rates, selling them today with the current high rates will mean losing money. And that's exactly what they did. The bank reported $1.8 billion in losses from selling bonds. From here on, the situation got worse. When customers saw that the bank sold its assets with a loss, this could only mean one thing, that the bank was struggling. And then they heated the whole situation even more by saying they planned to raise additional capital. That was when everyone started to freak out, and the market reacted immediately. The stock dropped 60% on March 9 after the announcement on capital raising. Then the stock dropped another 60% in the pre-market on Friday, March 10, and shares never reopened for trading again. The bank was officially closed on the same day by California Department of Financial Protection and Innovation. The collapse of Silicon Valley Bank started a chain of events. On the same Friday of SVB's sudden failure, the customers of Signature Bank withdrew over $10 billion in one day, causing its collapse. Signature Bank was officially closed 2 days later. But on March 19, Flagstaff Bank, a New York Community Bancorp subsidiary, agreed with regulators to purchase Signature Bank's deposit and loans. Later, regulators announced that depositors of both banks will have access to all of their money. This means that not only FDIC-insured deposits below $250,000 could be recovered, but also all the other accounts. Covering the uninsured deposits was crucial because SVB mainly worked with businesses, so 94% of their deposits were uninsured. Companies like Roku started to disclose hundreds of millions of dollars in deposits in Silicon Valley Bank. But even after all the measures taken, the panic didn't stop. Americans felt the uncertainty of the situation, and many started withdrawing money from regional banks, placing them in the major ones that were too big to fail. Then another bank collapse was on the way, First Republican. The scenario was the same. As customers started withdrawing money after the SVB collapse, 68% of the deposits at First Republican were uninsured, so people simply rushed to save their money. But What happened next differed from SVB and Signature cases. Treasury Secretary Janet Yellen started conversations with 11 major U.S. banks, and they agreed to deposit $30 billion in First Republic Bank. According to the announced deal, Bank of America, Wells Fargo, Citigroup, and JP Morgan Chase will contribute about $5 billion each. Goldman Sachs and Morgan Stanley will deposit around $2.5 billion. Truist, PNC, U.S. Bancorp, State Street, and Bank of New York Mellon will deposit about $1 billion each. Additionally, Yellen had a silent meeting with JP Morgan CEO Jimmy Dimon, and as a result, First Republican announced that they enhanced their financial position with the support of JP Morgan Chase & Co., which reportedly provides fast access to cash if needed. First, the shares of First Republic Bank continued their free fall despite the $30 billion pump it received from the U.S. largest bank. The situation could stabilize, but the trend is uncertain for now. The repercussions of difficulties in the U.S. banking system also reach over the Atlantic. Credit Suisse, a bank with over 167 years of history, failed as well. It had years of hard times. They were involved in several scandals, fraud cases, and money laundering prosecutions. In the fourth quarter of 2022, Credit Suisse clients pulled 110 billion Swiss francs, the equivalent of $119 billion. And the bank suffered its biggest annual loss since the financial crisis. So Credit Suisse was suffering long before the US banking collapse. You can see that clearly from the stock price. But why are we talking about Credit Suisse now? Is it important? Yes, it's one of 30 global systemically important banks. Its failure will have consequences throughout the entire financial system. Now, Credit Suisse was taken over by its rival, UBS, for $3.25 billion, 60% less than the bank's worth when markets closed 2 days prior. But wait, what actually caused this chain reaction? Why would Silicon Valley collapse in the first place? To find answers, we need to go back in time.
It was the worst day on Wall Street since the crash of 1987.
2008, the year when the housing bubble burst, the markets crashed, and millions of people lost their job. That was the biggest global financial crisis in decades. The US government and regulators had to react, and their response was to introduce nearly zero interest rates, print more money to inject into the economy, and apply quantitative easing, or QE. The last one was a new concept proposed by Ben Bernanke, chairman of the Federal Reserve at the time. Simply put, quantitative easing is a monetary policy where a central bank purchases government bonds or other assets to stimulate the economy. So the Fed started buying mortgage bonds for the first time in its almost 100-year history. Andrew Huszar was in charge of running this mortgage-backed securities bond buying program. The QE approach started to bring some good results. Some Americans began finding jobs. It brought some positive outcomes. But no one knew how and at what price. Because this was a new tool, it was more of an experiment. There was one major issue. The Fed was injecting trillions of dollars into the bank, and the idea was that they would lend that money at low interest rates to small businesses. But instead, the banks started investing in the same bonds the Fed bought. The Fed made it clear that its goal was to drive up the price of financial assets. So the banking sector saw an opportunity there. One part of the argument is that despite having the motivation to help Americans, the tools the Fed used mainly benefited Wall Street.
Its tools are disproportionately benefiting Wall Street.
The Fed continued to apply QE over the years, totaling 4 rounds in 2008, 2010, 2012, and 2020. As a result of the years-long stimulus, the Fed's balance sheet increased from $862 billion in August 2007 to $4.5 trillion by January 2015.
The purpose was to stabilize the financial system.
Everyone agreed that the American economy bounced back relatively fast after the financial crisis of 2008. However, many didn't understand why the money continued to pump, even when the major collapse was behind. There was no problem with stimulating the economy when it was very close to stopping altogether. And there was even no problem with printing money because the inflation was low. However, The real issue was that the Fed wasn't rushing to tighten its policies. Even inside the Fed, the concerns were rising.
In the third quarter of 2009, I said, let's start tapering back.
And the Fed's chairman also knew it.
When the economy begins to recover, that'll be the time that we need to unwind those programs.
It was easier said than done. The Fed tried to taper several times, but markets were reacting straight away with drops. A particular term appeared to call investors' reaction when the Fed announced scaling back its asset purchases, a taper tantrum. It is a strange concept for me as well, so don't worry. There were worries that additional rounds of QE could cause runaway inflation. Later, Andrew Huszar, who ran the bond buying program for some time, called quantitative easing the greatest backdoor Wall Street bailout of all time. Did he think it was a mistake? Well, he started his opinion article with the words, "I can only say, I'm sorry, America." One way or another, the Fed's quantitative easing started the longest bull run in the stock market history.
We've cleared away the rubble from the financial crisis, and we've begun to lay a new foundation for economic growth.
Another effect of QE was lowering long-term interest rates. This sounds like an excellent opportunity for small businesses, but low interest rates make risk more attractive. Look at how interest rates change over the years. At the end of 2008, they dropped to nearly 0%, and it continued like that for many years. And then, of course, the pandemic joined the game, resulting in another wave of record stimulus. The pandemic recession was the shortest on record, lasting only 3 months, but there were still multiple concepts if it wasn't just too much altogether.
There is a real risk here of this kind of massive stimulus overheating the economy.
Only Americans billionaire made $1.3 trillion during the pandemic, from March 2020 to February 2021. The Fed's main concern was employment and economic stability, but cheap money for a long time also drove markets a little crazy. Look at these headlines. Tesla surpasses $1 trillion market value. Apple becomes U.S. company to reach $3 trillion valuation. Jeff Bezos adds a record $13 billion in a single day to Fortune. The issue with skyrocketing valuations is that they have no foundation. For example, Tesla has the biggest valuation out of all car producers, but its auto market share globally is roughly 2%. In the case of Apple, their valuation didn't jump to the moon because they created a new technological miracle. No. It was because of cheap money, which also stimulated buybacks, meaning that companies borrow money to buy back their stock, making their remaining shares more valuable. And as a result, US companies face a record $10.5 trillion in corporate debt. It seems like there was simply too much cheap money. That's why we saw unimaginable company valuations, unreasonable expensive homes, so many people investing in cryptocurrencies, and an overheated market in the end. The rising inflation, higher interest, and banking crisis we see now are all consequences of the previous 14 years. The economy has its highs and lows, and these processes are natural. As for future predictions, the US Treasury assures that the banking system remains sound, and they don't see the potential for a global crisis.
We do know that the recent developments are very different than those of the global financial crisis.
In this video, I share how to protect your money in situations like these. So feel free to check it out, and I'll see you in the next video. Bye-bye.